Hey gang, welcome to Time in the Market, the investing channel with a long-term focus. Taking a look at Pepsi this morning. Is this stock getting interesting? You're getting to a valuation that we haven't seen all the way back to around 2013, 2014, somewhere thereabouts, trading with a 4.3% dividend yield, probably as high as it's ever been. This is a dividend king. You are partially buying the dividend here. If you're an investor in Pepsi, you're not expecting 10 to 20% annual returns. You're expecting the dividend to grow a little bit, maybe get a 2 to 3% return on top of that, and that's what you're getting. This is a safer play than some of these other growth stocks, but it's also one that's going to limit your upside, but also obviously limit your downside a little bit if you're worried about the stock market as a whole. Still, the downside is there. In 2008, the stock dropped 30% despite still generating free cash flow, still generating net income, still growing even. Even now, it dropped about 32% since the all-time highs in 2023. And a lot of that had to do with valuation being a bit too high. I think the CEO, Raman Lagwarta, probably on the chopping block or will be soon, because anytime you have a period of 5 years of 0% returns, when the stock market as a whole is doing really well, that's a bit of a problem. If you've been a shareholder of Pepsi during this period, not super excited. Really, Pepsi hasn't been super exciting for quite some time, but especially during this period as it got overvalued and is now correcting to valuations that may be interesting again. I think most people are aware of Pepsi and their businesses, so I won't go into the detail here. They're food and beverage manufacturer, distributor, and marketer of products. A lot of this stuff is marketing. They own Pepsi, they own Mountain Dew. Here are all the brands they own: Lay's, Gatorade, Cheetos, etc. They own Rockstar, an energy drink brand. They also have a 7.5% preferred stake in Celsius. Celsius just acquired Alani Nu. It'll be interesting to see if Pepsi becomes a distributor of Alani Nu as they are of Celsius. They have been making acquisitions recently as well. Acquired Sabra, or the 50% of Sabra they didn't already own, for about 250 million bucks. They acquired Siete for 1.2 billion. That's about a 3 to 4x sales multiple. It was hard to find the sales values of Siete. They acquired Poppi, a healthier for you soda brand. They paid about $2 billion, including some cash tax benefits, which is close to 4 to 5x multiple on sales. When you consider Pepsi as about a 2.4x enterprise value to revenue multiple. Kind of expensive, I suppose. That's been one of the things that's been said against Pepsi. At the end of the day, they are going to continue acquiring businesses every now and then. However, one must keep in mind they do have a decent amount of debt here. 40 billion. We'll look at the debt in a second. It's not the worst type of debt for sure, but they will have to refinance it as they go along, and interest rates are certainly higher than when they issued that debt. A lot of it was issued in 2020, which was a good move on the part of the CEO, but now they'll have to refinance at higher rates. And then also, a lot of their free cash flow is just taken up by this dividend. When you look at their payout ratio, it only shows about 78, 79%. However, on a free cash flow basis, in the last fiscal year, they paid off 100% of their free cash flow as a dividend. So that's something to keep in mind. If you look at the performance here, we talked about the negative performance in the last 5 years, negative 0.7% return before dividend. So you're still talking about a slightly positive return. We'll talk about why that is in a second, but you can go 10 years back, 3% return before dividends, all the way back to 2005, 4.5% return before dividends. Nothing amazing, but that's kind of what you can expect from Pepsi. It's going to be a dividend plus, 1 to 3% return depending on the valuation you buy it at. Maybe slightly higher if the valuation is really fantastic, slightly lower, like 0% if the valuation kind of sucks. You get a dividend that's pretty consistent, and maybe, just maybe, now that these interest rates and the dividend yield are sort of matching, Pepsi becomes more interesting, especially if the interest rates are going to head down anytime in the future. You look at the valuation. Why did the stock perform where it did in the last couple of years? Well, if you look at the valuations from 2020 to 2023, when interest rates were lower before they started to rise, people were looking for alternatives in the form of dividend stocks, and these stocks got a bit overbid. So you're trading anywhere from 2.5 to 4% free cash flow yields, depending on the year, depending on the month. That's away from the historical norms that were closer to 5 to 6%. And now, on the next 12-month basis, the stock is trading at about 5.5%, which is starting to get interesting again, starting to get back to that, hey, maybe we're going to see 3 to 4% returns before dividends. You add the dividend on top of that, you're going to get relatively decent returns. Speaking of the dividend, this thing is as high as it's ever been, a 4.4% yield. This is a stock that rarely trades above 4%. So if you're a dividend investor, certainly getting interesting. However, remember that their increases on a go-forward basis are likely going to be more muted than they have been because they're paying out quite a bit of their free cash flow as a dividend. Like I said, it was 100% of their free cash flow in the last year that was paid out as a dividend. I think their free cash flow is going to improve. I think their margins are going to get slightly better, but you're still talking about the majority of their money going out the door. Via the dividend, and they have to keep in mind that, hey, we already have a bunch of debt that we'll eventually have to refinance, repay, etc. Maybe use a little bit of that money to buy back stock, although they haven't been doing a ton of that. When you look at their performance as far as revenue growth goes, pretty flat from 2014 to 2020, then started to tick up. And a lot of this wasn't because of volume growth or anything like that. It was simply we have to raise prices because inflation is killing us on the cost side. So volume was pretty anemic, has been pretty anemic. This is a company that hasn't grown that much when you consider volume all the way back to 2014. So they're trying to buy avenues of growth via those acquisitions, moving into other businesses that I haven't been in, some of the healthier side of things. We'll see how that works. But end of day, I don't think you can expect a ton from Pepsi in terms of growth. Maybe they're going to grow at inflation levels. What you can expect is, hey, they're going to grow at inflation levels, maybe slightly improve margins, and continue raising their dividend a little bit, and they'll get a slight increase in bottom line EPS as they buy back a little bit of shares, as they grow that EPS a little bit through improving margins, and that'll flow down to maybe a 2 to 3% increase in stock price. Going back to their debt stack, not too bad. They issued a lot of this debt in 2020, so they have 2 to 4% debt that's due in the next couple of years. The thing to keep in mind is that's about 15 billion in debt from 25 to 29. What they issued in 2024 was closer to 4 to 5%. So if you just bump up this debt stack by 1% as they refinance it, if rates stay where they are and don't come down within this period, you're adding another $150 million in interest expense. If you do 2% for some of this super low debt, you're potentially adding another $300 million in interest expense. So 150 to 300 million in interest expense by 2030 on top of what they already pay today, unless debt comes down, which I don't foresee it happening anytime soon. So that's something to keep in mind as an investor as well. And now let's take a look at valuation. And disclaimer, this video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence. Again, we talked about Pepsi, $181 billion market cap, $220 billion enterprise value. Buyback-wise, hasn't been too impressive. 1 to 1.4 billion in the last 3 years, offset by about 300 to 400 million in stock-based compensation. So slightly reducing the share count, but not anything amazing. The dividend at about a 4.3% dividend yield right now. I'm raising that dividend by about 4% annually on a go-forward basis, means at today's prices, you're going to get about a 5% yield by 2029. One thing to keep in mind is that in 2024, they paid a $7.2 billion in total dividends versus $7.1 billion in free cash flow. So about 100% of their free cash flow is going out as a dividend, doesn't leave a ton of money for further raises, for stock buybacks, for acquiring new businesses, for paying down the bevy of debt they have. So they're going to have to refinance that a bit and or stop growing their dividend as much as 4%. As far as revenue growth goes, I think 0% growth is expected for 25. I think they can pick that up to about 2.5% all the way through 2029. Really, it's inflation. That's what they're growing at. They're raising prices a little bit, trying to keep volume the same, adding new businesses in Siete and Papi and Sabra, etc. They do have to improve margins. That's really the name of the game for Pepsi. If the margins stay in the 7 to 8% range, this is going to be a poor return or a poor compounder. I'm assuming 9% margins in 2025, all the way up to 10% by 2029. Buyback wise, not a lot. Like I said, they're spending the majority of their money on dividends. They're going to have about $3 to $4 billion in post-dividend free cash flow. Their net buyback here at 10% is only about $2.7 billion after stock-based compensation. They don't have any excess free cash flow to pay down debt, to buy back shares. I think they're going to probably take on more debt to buy back shares if their valuation stays lean. When I look at valuation, I think 5% free cash flow yield for something like Pepsi is the right move here. That's where they've historically traded when the returns have been decent-ish. If you want to play around with this spreadsheet, hit file, make a copy. There will be a link in the description down below. At that level, at today's prices, I get about a 7.1% expected return, kind of what you've gotten if you've held Pepsi outside of the last 5 years where the free cash flow yield was closer to 3%. You get about a 2 to 3% return on buybacks and just, bottom line growth. Then you get the dividend yield, gets you to the 7.13% return. If you want a better return, let's say you want a 10% target return before dividends, gets you to about a 14% return after dividends. Very unrealistic for Pepsi. You'd need a fair value of $93. Probably not going to happen, but that's what you would need. If you want a 10% target return after dividends, you get a fair value of about $113. That gets you to close to 10% or so at a 5% free cash flow yield. Obviously, if you think the 4% free cash flow yield is the right spot for Pepsi, that's a bit of a different story. So what's the reality here at $132? The reality here is that you're going to get that 3% return that you've seen in the last 10 years. You remember this graph that we looked at. If you go all the way up here, show the price chart and go back 10 years, it's a 3% return because over here it was trading close to 5%. It's kind of trading close to there right now at about a 4.5% free cash flow yield on a next 12-month basis. You get that 3% return. You add the dividend on top of that. You get about a 7% return at today's prices, gets you to a fair value of 129. If you're buying Pepsi today, that's what you're expecting. That's probably what you're going to get. There's upside from here in the sense that, hey, if interest rates drop, the same thing might happen that happened in 2020, 2021, 2022, that these valuations will get more expensive. People will seek out the dividend yield from Pepsi because it's a safe play. They'll take this down to a 4%, which gets you to an 11% return, or a 3%, which gets you to a 16% return. What's the downside? Well, the downside, again, if there's a recession, even in 2008 when it was trading at this level, it still dropped 30%. So 30% downside, decent upside from here. That's kind of the trade-off you're taking. You're looking at this and saying, this is a dividend king. Pepsi isn't going to go out of business in the next 10 to 15 to 20 years. I can either buy Pepsi and get a 4% yield, 4.3% yield, with potential upside from there in terms of growth and margin expansion, or I can buy a treasury bond and get a 4.3% yield with no upside in terms of growth or expansion, lock that in and have, inflation risk, or buy Pepsi and sort of be covered off on inflation, potentially get some upside with price appreciation by taking on the risk of the downside that may exist. So that's something you have to keep in mind. I'm certainly looking at Pepsi close right now for some of the portfolios I manage for people that depend on dividends. They're not really looking for growth, for appreciation. They're just looking for steadiness in their portfolio and income they can live on. If you're that type of person, Pepsi is looking interesting again. You're not going to get a 20 to 30% return in the next 12 to 24 months. You might get a decent return if interest rates start to drop, but you have to depend on that. If interest rates stay steady, you're going to get a 3% annual return plus your dividend. That dividend's going to go up 2 to 4% every single year as this company refinances, assuming they can execute on the improvement in margins. They can integrate some of these acquisitions well and sort of start growing just a little bit. They don't have to grow a lot, with the potential upside of growth on the pricing side, pricing of the stock, if interest rates drop and the stock price goes up because of that. So let me know what you think about Pepsi. Am I wrong in any of this? Are you in disagreement around my valuation? Leave a comment down below, like and subscribe and all of that good stuff. And as always, thanks for watching, and I'll see you here another day. Bye. And one final note about Pepsi is that there are real risks investors have to keep in mind here. GLP-1s are an obvious one. You'll look at those drugs becoming more prevalent in society. Are people drinking less sugary drinks and eating less snacks because they're on those drugs, because they're losing weight? That's certainly a risk to a company like Pepsi. That's why they're moving into the healthier space to offset some of those losses. If you look at the pricing increases they took in 2020, 2021, and 2022 to keep their margins where they are, that's going to take a hit to volume. People are struggling on a day-to-day basis. Are they going to be buying down to other brands, to cheaper brands, to white label products? That's something to keep in mind if you're an investor in Pepsi. And then on top of that, you've got the overall competitive space that's just getting bigger and bigger. It seems like it's a lot easier to start your own brand. Poppy was just a nascent brand a couple of years ago. Now they're getting bought out by Pepsi for $2 billion. There's other drink brands. Every time I go to the grocery store, I see random new drinks that are out there. They're not only in the energy drink space, that's certainly gotten more competitive, but also in the soft drink space, and that's certainly going to impact a company like Pepsi. So a variety of things. Some others I probably forgot to mention. So if I did forget anything, let me know in the comments down below. And again, thanks for watching. Bye.